Welcome everybody to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is my partner Cameron Mealy. First of all, wish everybody happy holidays. It's been a unique year, and today we're going to talk a little bit about what's happened over the last month from an economic standpoint, what's been going on with the portfolios, and really what our short-term outlook is going into the new year. Cameron, why don't you kick off with some economic news?
Sure, Kelly. It seems like every month we've kind of revisited what's going on with GDP during 2020. And, we'll start again with a refresher. So in the first quarter, we saw a negative 5% annualized GDP decline. In the second quarter, as we went into massive shutdowns, we saw a 31.4% annualized decline in GDP. And then in the third quarter, as we saw reopening, we saw a historic increase in GDP, 33.1%. So it begs the question, what are you looking at for the fourth quarter? The Atlanta Fed has a model we've talked about before called GDP Now, and they're predicting an 11.2% increase in fourth quarter GDP on an annualized basis. So slight downtick in the first quarter, massive downtick in the second quarter, historical increase in the third quarter, strong increase in the fourth quarter, mostly driven by holiday and retail. And what it really comes down to is, if you take all those numbers and put them together, we're really only looking at about a 2 to 3% GDP decline, according to most economists, in 2020. And to think about with the massive disruptions that COVID's caused, what does that tell us? I mean, two things really. Number one, the resiliency of the U.S. economy and the U.S. consumer. We are the world's largest economy. We're also one of the world's most diverse economies. We've got winners, we've got losers. Obviously, tech has been a huge winner. Hospitality has been a huge loser. Manufacturing's been strong. The consumer is out there and they're spending money. So we've got a very resilient economy, and number two, and you can't argue with this, a lot of government spending. So we've seen $4 trillion of stimulus already. Looks like we're going to get at least another $1 trillion of stimulus, hopefully by the end of the year, if not in the first quarter. So really, we're seeing the government prop up the economy. I mean, PPP was an expensive program, but I really do think it's been a lifesaver. I mean, it really has, it's protected jobs. It's kept doors open, it's kept food on tables, it's done exactly what we expected. Now, why is more stimulus necessary? Because while we do have a resurgent economy, we are starting to see some slowdown. So last week, according to the Bureau of Labor Statistics, total non-farm payroll employment rose by 245,000 in November, and the unemployment rate edged down to 6.7%. These improvements reflect the continued resumption of economic activity that had been curtailed by COVID-19, though the pace of improvement has moderated in recent months. So if you look at most experts, they were expecting about 600,000 jobs to be added in November, anywhere between 5 to 600,000. That number came in at 245, so well below expectations, but we did see the unemployment rate dip down to 6.7%. And if you remember, we were at 14.7% unemployment, which was near historic highs. Now we're down to 6.7, which, in any given year over our modern history is a pretty acceptable number. We're just used to the number being so low now. But, that really says that with non-farm payrolls growing at the slowest pace in a while, that, this stimulus is needed. The government needs to continue to prop up the economy. We've got to work our way through this COVID issue. I see more government spending extending into 2021. And I think at this point, neither side, left or right, nobody cares about, what could be the long-term ramifications of government spending. I think everybody is determined that, to stay in power, they need to spend, they need to keep the American people happy.
I agree. We have, a good 3 to 5 month window where, obviously the unemployment, the improvement slowed down in the last month or so because of the acceleration of COVID, and those numbers have gotten to crazy high levels that in my mind it's hard to believe how that pace is going to subside, especially getting through the New Year's holiday, the Christmas New Year's holiday. If anything, we could probably we might see those numbers get worse over the next month or so.
Certainly, people are going to be gathering.
Right. So the improvement I think really is going to come second half of the year. Maybe you start to see improvement second quarter, improvement comes second half of the year. That's when you start to see the GDP maybe accelerate again. I read a good piece this morning, and they're only estimating 3 to 4% GDP growth for the whole of 2021, which doesn't quite get us back to where we were beginning of this year. That's the thing is, even though we've seen great improvement, the economy is definitely smaller than what it was, and it may still be smaller by the end of next year. So we're looking at a 2-year recovery period from a true GDP standpoint. But the other side of the coin is with the stock market and businesses, some businesses have thrived in this, others have fallen by the wayside. There's still a lot of damage that needs to be addressed. Stimulus, I think, will inadvertently continue. Biden's announcement that having Janet Yellen as Treasury Secretary, that will, she is definitely very dovish, and she is not afraid to, she will not push back on more spending, whether it's done through the Fed or through, actual fiscal stimulus. That's going to, that game's going to continue. So, we'll definitely have monetary and fiscal stimulus at our backs, at least for a while.
Which means we should start seeing the creeping of inflation. You can only push so many dollars out.
Exactly, and that's my biggest fear going into next year is, inflation. How does it manifest itself? Is it the traditional inflation that we saw back in the late 70s, 80s, or is it a new type of inflation maybe that we're already seeing in asset prices, where you have, tech stocks becoming way overvalued, where the money's really going and where we're seeing the prices rise? It's hard to say how it's going to manifest itself. We're already starting to see in the industrial commodities, we're starting to see prices impact or tick up there. Pressure on the dollar, maybe a weakening dollar, which makes our currency a little less valuable. But that's a form of inflation. That's probably what's coming down the pipe, and it
is an interesting case study because you're not seeing the wholesale inflation that we saw in the 70s and 80s,
right.
But assets, whether it's real estate, whether it's stocks, whether it's jewelry, whether it's fine art, you are seeing a significant increase in prices, largely driven by the upper class.
Correct, and that's where it's a weird dynamic because of who it's affecting. If there are more luxury goods that are seeing the inflationary pressures, what does that really mean? It's really just kind of a tax on the American people to pay for all this through inflation. And maybe it is progressive, which is fine. And will that be an argument for really no major tax increases? Which, even the tax increases that Biden had proposed they're not as draconian. They're not draconian. They're not overbearing. They're not going to be a major issue, and
they're well within historic norms.
Will it even happen in the short term while the economy is still weak? Which I doubt, especially if there's more of a balance in the Senate and the House, which it appears that's what it's going to be. So, not real concerned about the political ends of it. What the Fed's going to do, what the Congress does. Yeah, we know there's inflation, and it's just trying to figure out how do we play that inflation, how do we pack that into the portfolios. Once again, like I said, that's a big issue that I have in my mind. The other issue is, valuations. How much more stretch can valuations get in the market?
Well, I think as the government continues to spend, that's going to drive. When consumers have money, they're spending it, and when
Correct.
they get stimulus, they're spending it. And what are they largely spending it on? They're spending it on technology. And so we can continue, at least in my mind, what we're going to see in 2021 is we're going to see continued government spending. We're going to see a continued divergence between the winners and the losers.
Yep.
And the winners, big tech, those valuations continue to stretch. We're going to see the beginnings of creepings of inflation. And frankly, if Joe Biden does become president of the United States, we're going to see increased regulation.
Absolutely.
And so
it's going to be an interesting year.
Yeah.
One thing I do think is going to happen, and we may have talked about this a little bit last time, was the volatility and the swings in the market, I think, will be more frequent.
Yeah.
We saw a 10% pullback in September, 10% or almost 10 in October. November was almost straight up, and that kind of dovetails into what's been going on. Did we hit all your points?
Yeah.
Okay. Yeah, so I'm just going to dovetail right into what's been going on in the markets. So for November, the Dow Jones, Dow was up 11.84%. The S&P was up 10.75%. So we saw a little bit of a switch there. Year to date, the Dow is still only up 3.86% versus the S&P, which is up 12.1%. So you're seeing a little bit of a swing there. The S&P right now is being driven by the big tech companies. Dow Jones, the exposure there is a lot less. So it looks like the non-tech started to catch more bids, and we saw a little bit of movement there, maybe a little rotation to more cyclical names, and really names that have more reasonable valuations is kind of how it looks right now. The NASDAQ, year to date is up 19.51, and that's even higher now, just after the first weekend of the month. For the month of November, NASDAQ was only up 5.79%. Small cap stocks last month, the Russell 2000 up 18.29%. So once again, kind of looking at other areas where valuations are a little more reasonable. That's why you're starting to see more money flow to the small cap stocks. You're seeing better performance happening there. International stocks caught a bid for the month, up 15.38%. Emerging markets up 9.2%, a little bit of a laggard there. So, I don't have a good explanation why emerging markets lagged a little bit last month. From a portfolio standpoint, a good month, pretty much across the board. Growth with income. Year to date, we're up now 10.5% roughly. For November, only up about a little bit over 5%. Winners in growth with income, for the month, Microchip was up 28%. Honeywell, big industrial company, up 24%. CVS up 20.86%. Disney up nice 22%. Our big losers last month, Digital Realty, which is basically a real estate company that they just own properties for server farms. They were down 6.62. Gold, which has worked out really well for us all year. Gold backed up a little bit, down 5.41%. That's a position that is really in there as a hedge position. It's definitely been, when there's been turmoil, gold's worked well for us. We're not going to step away from it. But the reality is hey, it's going to have its ups and downs. So a little bit of pullback there just through all the strength in November, not surprising. Year to date, Apple up 63.57%, NVIDIA up 128%, Nike up 34%, Microchip up 30%, our emerging markets fund up 20%. That's why the portfolio is up 10.5% for the year. In the dividend yield portfolio, November we're up 9%, year to date we're up 3%. Our big winners in there, UPS up 51% for the year, Eaton up 32% for the year, Caterpillar, believe it or not, up 21% for the year. Paychex up 13% for the year. Our losers so far this year, AT&T, struggling, down 21% for the year. Intel also struggling a bit, down 17% for the year. British Tobacco down 12% for the year. So that's kind of dividend yield going back and forth. Starting to catch a bid. Last month was a good month for it. Price potential, where we've struggled a lot this year. So November price potential is up about 10.25 for the month. Year to date, we're up about 1.25. So big disappointment in price potential. We're not losing faith. We're going to stick with our strategy in there. Of companies we're still holding, our big gainer in there is Pepsi, up almost 8%, 7.8%. What worked in November, we saw Aflac up about a little over 30%. Allstate up 16%. Genpack up 18%. Edwards Life Sciences up 12%. The CBOE picked up another 12% there for price potential. Our small caps, we saw a lot of action there last month, up 18.25 for the month. Year to date, we're up a little bit over 19%. Big winners in November, Appian Corp, which we've only held for a couple months now, that was up 121%. Progeny up 45%. Veracyte up 57%. Kodiak Life Sciences up 50%. Fulgent Technologies up 38%. So some pretty big winners there. On the downside in SMID for the month, Omega Flex down 5%. Now Amphastar Pharmaceuticals down 9%. So no big losers, a lot of big winners. Obviously a strong month for SMID. So that's kind of where we're at. So good month last month. This month we're seeing starting to see a little bit of weakness the last couple days. Mm-hmm. I don't think it's going to be severe, but on any kind of major pullback, that's going to present some buying opportunities. In general, I like where we're positioned, but the key is keep the seatbelt on. We're going to see some volatility.
Well, the market's at an all-time high, so
right.
For any of our clients that have looked at their accounts, you will notice that as we are selling off positions, we're not necessarily buying up as aggressively as might have in the past.
Correct.
Valuations are high. We are sitting on cash. As we see pullbacks, we'll put cash to work. But right now, it's about being cautious. It's about taking a very measured approach. We're trying to avoid the high flyers. We're trying to avoid the aggressive valuations. We're trying to stick to our guns, and our guns are, managing for the long term and being conservative.
So that's where we're at. If you have any questions, concerns, please give us a call. One reminder, clients over age 72, if we have not discussed this yet, but there are no required minimum distributions from IRAs this year. So, if you still want to have some money come out, give us a call. If not, we're good to go, and we'll start the RMDs again starting in January 21.
From the Ellsworth Advisors family to your family, happy holidays. Hope you have a great holiday season. Let's hope 2021 is a little more exciting than 2020. And be safe. Thank you very much.
Thank you. Have a great holiday.